Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. One of the recurring themes of reporting this year was the revival of parts, at least, of the local property sector. Data centres, retail, even office blocks found some favour with investors, whereas residential still seems to be struggling. So what should investors make of the somewhat mixed sector? Remember, this is general information only, and you should always seek professional advice before making investment decisions. Lou Pirenc is the head of Property and REITs Equity Research at Jarden Australia. Lou, welcome to Fear and Greed.
Thanks, Sean. Good to be here.
So let's take a top-line view of it. What do you make of REITs at the moment? And then we'll jump in and go through the specific types.
No, sounds good. No, I think REITs are in a good position. With the first interest rate cut earlier in the year, and the Jarden expectation is that we'll get one or two more later in the year. That's a good backdrop for the REITs. Most companies reported that they're at the trough of their property valuation cycle. Most companies will probably hit a trough in earnings in the next 6 to 12 months as well. So the outlook over the next few years is positive across the board.
Okay, so just explain to listeners, Lou, why property and real estate investment trusts are so interest rate sensitive.
Yes, I think there's two main reasons for it. First of all, property investment has always involved leverage, so debt. So returns are clearly impacted by the fact whether your cost of debt is going up or down. And then I guess the second, which is maybe even the more important reason for it, is that properties get revalued, particularly in listed land, every 6 months. And the benchmark rate or in a DCF valuation, one of the main inputs is the cost of capital, which again is a combination of the cost of debt or the risk-free rate and then the risk premium. So that's why it changes. Long-term investors, should really look at the long-term cost of debt. But what we've seen in previous cycles is that it's always very tempting when interest rates come down to ignore the longer-term cost of debt, but to just play the shorter-term debt cost cycle.
Okay, and just on that revaluation, you talk about the DCF. What that effectively means is that the higher an interest rate, the discounted cash flow, that's what DCF is lower. So that's bad for the REIT. So with interest rates potentially falling, that should be good for REITs. Am I right in saying that?
Absolutely, yes. Falling interest rates is good for REITs. I mean, of course, it's a little bit more complicated than that, is that there's always a reason why interest rates are falling. So it normally means that the economy is slowing down, which has some impact, or depending on the asset class. But simplistically, a lower interest rate environment is good for property.
Okay, so let's get into the asset classes. Let's start with industrial/data centres. I mean, we seem to, because of Goodman Group in Australia, we seem to conflagate the two together nowadays. But what about industrial? What's that looking like? It's kind of been the darling of the market ever since COVID, really, at least until data centres came along.
Yes, no, that's right. And it is probably still quite important to separate data centers from logistics, even though it's often the same land and the building structures can look quite similar. But from a cycle point of view, they're quite separate. So logistics, yes, have had an exceptional period of growth. It started even before COVID with, just the emergence of e-commerce. Traditional retailers really needed to respond to that by pushing through supply chain efficiencies, which involved, bigger, more modern warehouses. And then COVID really was, the icing on the cake, which accelerated this whole e-commerce story. And this was all in a time when there wasn't that much supply. Vacancy was already quite low. We're now coming towards the end of this cycle where demand is normalizing. Vacancy it's still low. It's 2-3%, but it's going up, which means that rents or rental growth is slowing down a little bit. So we're still quite constructive on logistics, but growth is certainly slowing down from the last, 5-6 years.
Okay, and data centres and Goodman Group, which is the market leader here in Australia, they have pushed heavily into data centres. Am I right in saying future income's likely to be about, well, no, not future income, but I think future work is about 45% data centres for that group now. I mean, what's the outlook and why is everyone so into data centres?
Yeah, no, the outlook there is positive. Given how new the asset class is, it's still a little bit, there's always a little bit of uncertainty about, how big this opportunity can be. But with the growth in cloud computing and now the emergence of AI computing, all of that computing needs chips. The chips need to be stored in climate controlled and, powered facilities, data centers. And given the expectation of growth in cloud and AI, the expectation is that the demand for data centers is going to be exponential over the next few years globally. So I guess that companies that have land in the right location and more importantly, power connected to the land are going to be in a very good position. And Goodman, which clearly has done logistics very well for a very long time, they are sitting on a 5 gigawatt pipeline of power, which they hope to activate over the next 10 plus years. And then work with, the hyperscalers, so the Amazons and the Microsoft of this world, to basically build facilities for them.
Is there any chance that it's a bit overhyped, such that AI will improve, so the use of the amount of storage space, the amount of chips isn't quite as much as we think it might be at the moment?
It's possible. Ultimately, we don't have a lot of data to go on yet. But judging by or what we can look at is, what the hyperscalers or the big AI companies are telling us on their growth. And based on that and, industry experts, which, of course, are all a little bit biased as well. But based on all that, the growth will be there. The question is, is it, 10x? Is it 50x? Is it 100x of the current demand? And nobody really will be able to give you the definitive answer. And clearly, a lot of players are now starting to jump into the supply side. Everybody wants to build data centers. So it's definitely something that we need to keep watching. At the moment, there's not really any empty data center anywhere in the world. So that tells us that right now, the supply-demand balance is in favor of the current owners of data centers. But that's something that we need to watch. Like in any other asset class, demand is one thing, but you need to watch that there's not too much supply either.
Stay with me, Lou. We'll be back in a moment. I'm speaking to Lou Pirenc from Jarden Australia. Let's take a look at a couple of sectors which haven't had as good a time of it, but seem to be rebounding pretty well. Retail. Now, I noticed, I think it was Scentre Group or one of those big mall operators was talking about the lack of retail space, which is a good thing, obviously, for Scentre shareholders. Where do you see retail going?
We are very constructive on retail. Clearly you have strong population growth that is likely to continue. And really, since COVID, there hasn't been any supply growth in whether it's in malls. Maybe there's a few neighborhood centers around new communities in Australia, but generally, supply growth is very limited. So that's clearly, positive when you're negotiating lease terms with your tenants. Before COVID, we were very nervous about, the emergence of e-commerce and, all of us stopping going to the mall and all going to buy all our things on Amazon and other websites. But I feel that, COVID again accelerated the trend and also made retailers realize that just having a website is not really enough. You need bricks and mortar presence for marketing, for people to, people still like to shop. People still like to, touch and feel the products that they buy. So I would say that most retailers have found that the right balance between, the number of stores that they want to own, depending on the brand. And then clearly they need a very good web and online presence as well. So as long as, we don't see the emergence of a lot of new malls or malls expanding, the supply-demand dynamic should be very positive.
Office. Now, I can't find a car park in my local train station in the morning if I'm there after 7:30 in the morning. I reckon everyone's back in the office. That's my theory, but it's very, very anecdotal. Investors seem to like office again somewhat.
Yeah, somewhat. It's coming from a very low base. And yeah. I would definitely say that the fundamentals are not getting incrementally worse. They're getting incrementally better. But it's still very dependent on where you are. Sydney is a lot stronger than Melbourne as the two largest markets. Brisbane and Perth have always been a little bit more resilient. So Sydney is recovering stronger. And then even within Sydney, the core or premium buildings in the core CBD are performing a lot stronger than some of the, outer CBD buildings. So yes, the outlook is stronger. And if developers can remain disciplined, the outlook should be strong. And I say that because what we've seen in the last 5 or 6 years is that every time demand picks up, somebody will basically build a new, 60, 70, 80,000 square meter building. And, even if demand is strong, demand has to be very strong to absorb all that new supply. So at the moment, vacancy is still quite elevated, about 13% in Sydney, 18% in Melbourne. Roughly speaking, you need to be below 7% vacancy to have real pricing power. So there's still, a long way to go. Kind of demand really needs to pick up a lot stronger before, I think office becomes a real bang the table rental growth type market.
Okay, Lou, let's bring it to residential. A little bit of good news on residential, though it still seems to be the poor cousin.
No, and it also depends a bit who you are, whether just a homeowner or whether you're a developer that wants to build more supply. Again, we are getting more constructive on residential after a very difficult period. And there's kind of three elements to this. The first one is the structural element, and that has been positive for some time. I mean, you will have heard about undersupply for quite some time. There's a lot of people that would like to buy a house, would like to rent, but they just can't find something, or at least not something that is affordable. And that has been strong, and that provides a very attractive backdrop to residential overall. The cyclical story has been more difficult, clearly with high interest rates, which has made the affordability even harder. That is starting to improve, with the first rate cut. Hopefully we have more rate cuts coming our way. Going into an election cycle, I think every politician in Australia is going to make this a very big part of their campaigns, because the housing supply situation needs to improve. We're not going to solve this by creating more demand, because the demand is there. We just need more housing. And we're seeing pockets of that. New South Wales have had some real success with, basically state authorities taking control of this and basically looking at, stations or certain areas where they say we're going to accelerate approvals, zoning changes to basically create more supply. And then the third part of that is that the developers, Mirvac and Stockland are the two largest ones, have also worked through some of their weaker projects and have made improvements to their capital structures, to their pipelines. Yeah, so I think that assuming that cyclical part is coming to the party, the outlook for developers will be strong, and hopefully that will not come at the expense of, prices, going up too strongly, which, is great if you own a house, is not so great if you're, still trying to get on the property ladder.
Lou, thank you for talking to Fear and Greed.
Thank you.
That was Lou Pirenc, Head of Property and REITs Equity Research at Jarden Australia. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before investing. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.